Hello everyone, welcome once again. Today we have a special weekly video report. So this is going to be quite a long video and we're going to be covering a lot of different topics. So starting of course with the recent sell-off in equities and also that sell-off in treasuries. So what exactly is, creating this sell-off in equities? Why have rates climbed so high? And what can we expect moving forward? So, we're going to be talking a lot about Fed policy, liquidity, and basically the outlook for rates and equities. Now, overall, I think this is a very good opportunity. I think the markets could be bottoming in the week ahead, so definitely going to be a very interesting week. Now, I'm also going to take this chance to talk about the outlook for 2024 in terms of inflation and employment and basically recession. So we have quite a lot of interesting things happening at the moment. Obviously fiscal spending ramping up at a time when unemployment is at historical lows, and overall analysts seeing quite a bullish outlook for earnings. So quite interesting in the face of the current sell-off in equities. Now, I'm also going to be talking about gold, which of course has been on an absolute tear in the last week and is making us think, could this be a new bull market for gold? And lastly, we also have to talk about crypto and Bitcoin. Obviously, Bitcoin also rallying right now, challenging that $30,000 level, basically on the hopes that that ETF could be approved, and some other very interesting altcoins doing very well. So stay tuned for that. Now, this type of long form video is something that I do weekly for my subscribers. I'm giving you the chance today to look at it. So if you like this type of content, make sure that you're following me if you want to get more of it. As always, enjoy and let's get right into it. Hey guys, welcome to another weekend update. Now let's begin today by addressing the elephant in the room, of course, which has been the steep sell-off in stocks that we have seen over the last few weeks, which has of course been paired with a sell-off in treasuries, which are reaching record highs, or the rates are reaching record highs. Now, let's begin first by looking at the technical side of this equation, and then we're going to talk a little bit about more. Then we're going to talk a little bit more about the fundamentals. Now, first of all, as you'll know, this sell-off really hasn't surprised us that much, to the extent that we've got some pretty clear signals of the sell-off, and in terms of Fibonacci retracements, we're pretty much close to our targets. Now, of course, when we reached this high in wave 3 at about 4,600, we already saw that this was kind of getting quite close to one of our initial Elliott wave targets, right? So if we measure, first of all, this wave 1 from the bottom of our wave 2, we'll notice that that wave 3 pretty much tagged the 1.272 extension, right? And then, of course, we've got a very impulsive move down, and then this bounce in B, which was very clearly corrective. So at the very least from here, I was already talking about how this could be a good shorting possibility, and indeed it was, right? So we can actually see that we have retraced now almost to about 4,200. We're back at those lows after this bounce, this kind of a short squeeze, perhaps we could call it. And now basically we're approaching a very significant support levels, right? Support levels we've been talking about for a while. First of all, of course, we have the 50% here at about 41.94, followed by the 61.8% retracement of our wave 3 here at 4,000, right? Or well, a little bit higher, 4,100 rather. And of course, very important, we have a lot of volume coming in at this level. So this is pretty much where you'd expect the, where you'd expect to find some support. Of course, we have sliced through that 200-day moving average, but this is something that can happen, and I think it was really necessary in order to really bring the bearishness down, right? So, it's very easy to keep calm as long as you're above the 200-day moving average. But, once you break through it, people start losing their marbles a little bit, right? So I think now we're getting close to, the kind of levels that, first of all, we're close to the support, and, bearishness is now at a level where we could expect a rebound. And we'll talk about that a little bit more as well further on. In any case, the primary scenario, the long-term picture still remains, right? That we are heading further up in a wave 5 over the next few months. And basically, the target is around 5,000 perhaps. So, of course, going back maybe to our wave 1, if we measure that wave 1 from here, and measure from the bottom of our wave 2, then we'd expect our wave 5 to, at the very least, maybe touch that 1.618 extension. or perhaps even the 2 extension, right? So somewhere around there. Now, of course, there are other ways of measuring this. For example, we could also look at, kind of assume that this wave 4 is going to end maybe around here and look at the inverse 1.618 extension of that. So that would take us to around 4,900. So again, also close to about that 5,000 level. So somewhere in that ballpark, and of course, we'd expect to see, your classic early wave structure here. Well, actually, no, because this is a ending diagonal here, right? So we've got ABCs all the way along. So we'd expect another ABC probably to finish off this 5 of 5, okay? Now, that is in terms of the technical analysis, but of course, what has been happening in terms of the fundamentals? Now, in terms of the fundamentals, of course, this sell-off in US stocks can be pretty much correlated to the rise in bond yields, right? Rises that have happened, mostly on the long end of the curve, and basically, once again, pretty much in line with what we were expecting. For example, this is the US 10-year, which we've been tracking, and we can see that, we were sort of expecting to reach this 1.618 extension at about 5%. We have now reached that, and, we're starting to see some signs of reversal here, right? So first of all, of course, we reached the target in terms of Fibonacci, so that's obviously the first sign. Secondly, we, of course, have begun to build a divergence here, right? So definitely running out of steam a little bit. So we've definitely seen a bit of a climax in buying and short selling. There's some charts out there that show the positioning, again, extremely bearish. So a lot of good contrarian signals that are showing us that rates could turn around. Now, again, though, why did rates go up in this way, right? So there are two kind of factors we can point at here that really have, I think, affected the trajectory of rates over the last month, right? One of them is, of course, the Fed dot plot, right? Now, in the September meeting, the Fed brought out its dot plot and it actually changed substantially compared to what we had before, right? So the market has actually reacted to this. So actually, we can see here the September 2023 Fed dot plot is more hawkish than the June 2023 dot plot, as the median Fed funds rate projection for 2024 and 2025 was 0.5 percentage points or 50 basis points higher, right? So basically, the short of this is that basically the market finally kind of listened to the Federal Reserve, right? After playing a bit of a game of chicken, and Jerome Powell coming out, time and time again, talking about higher for longer. Well, the message kind of finally got through to the market, and basically they began to price in this change, especially after the September meeting. Now, the other reason why there's another couple of reasons why rates could have gone up in this fashion. Now, one of them I've talked about a lot before, and it's that idea that, a lot of international buyers simply aren't there anymore, right? China, Japan, the Saudis. And the other argument, though, is that also that these higher rates could be signaling higher growth in the future and maybe also higher inflation, right? So first of all, if you remember from my podcast with George Robertson, he talks a lot about the growth of NGDP. And indeed, we've seen a lot of forecasts. In fact, the Fed forecast for the next quarter has been revised upwards again. I think it's now at about 5.4% growth. And this is also reflected, basically, if we look at the S&P quarterly bottom-up EPS actuals and estimates, right? So we can see here that, we have quite a steady line of growth in terms of expectations for earnings, right? So analysts are quite bullish. And, in fact, Mike Zaccardi here, who I also had the pleasure of interviewing a few weeks ago, talks about this, and he says, if stocks continue to sag, the P/E ratio will look even better, already well under 18 at 17.6. So actually, in a lot of ways, not that the stock market is undervalued, but, at the current levels with this sell-off and actually the expectations of much higher growth in the future, we're seeing a big kind of dichotomy there. And valuation, if you believe these these estimates, is actually quite favorable, right? So kind of interesting to see that, right? So I mean, either these estimates aren't right, or the stocks. I mean, stocks have to catch up eventually, right? I mean, stocks do move with with earnings ultimately. Now, on the other hand, we've also seen a big spike in the break-even tip. So this could actually signal that markets aren't that convinced about the disinflation narrative. Now, I have talked about how I think that the path down to 2% could be a lot harder, right? And there's a few factors playing into this. And long term, of course, I do think that inflation could persist. But anyway, obviously, the tips, going up here also could be a big reason why the yields have moved up so much, right? And of course, this could have contributed to the sell-off in stocks, right? Now, the other thing we have to understand is that higher bond yields, right, kind of affect liquidity negatively, right? So if you have those higher yields or rather lower bond prices, this is actually shrinking the level of quote unquote collateral in the system, which is pretty bad for liquidity. But in any case, in the face of all this, we actually returning here to the Federal Reserve. What's very interesting to see, right, is that basically in the last week, especially, expectations have completely reversed, right? So actually, I believe it was when we got that jobless report. I think markets started pricing in that that another rate hike perhaps for the next meeting. Now, after the recent rise in yields and sell-off in stocks, the market is finally kind of doing the Fed's work for it, and we can see now that obviously possibilities, the likelihood of a rate hike in the next meeting in November is about 0%, and the likelihood of a meeting of a sorry of a rate cut in the next meeting has actually, and the likelihood of a rate hike in the following meeting has also decreased substantially, now at 90%. So basically, markets now pricing in that the Fed is pretty much done with the hiking cycle, I think. And I think I would tend to agree with that. Now, a lot of this will, of course, depend on the kind of data we get. But overall, I think that we're getting close to that Fed target. And, maybe they're not even going to be that bothered, right, if we stay at 2-3%. So with that said, potentially a very good place to buy the dip here, in my opinion. Now, of course, we did get that Bank of America bull and bear indicator signaling a strong buy, basically on the extreme bearishness in the market, right? And you can see here how this indicator is made up. Hedge fund positioning, of course. So we can see here in this table how this indicator is made up, and we can see that we have reached extreme bearishness, right? So a lot of market participants are now positioned quite bearish. Obviously, if we look, for example, at the fear ingredient index, we are now quite near fear. And if we look, for example, I believe we had something like we had like record outflows of cash in the last week. So again, market participants are getting very bearish, and this can often act as a good contrarian signal. We can also see here, for example, the long to short ratio, and here pretty much reaching peak shortness, right? And again, bit of a contrarian signal, right? We can see that basically the market was kind of peak long at the top and tends to get peak short at the bottoms, right? Now, going back to the outlook for 2024, right? Because right now we're getting to a point where, obviously we were talking for a long time about recession. That didn't quite happen. Now, the odds of that soft landing, I think it's at about 50%. Again, could this also be a contrarian signal? We have to think that in order to trigger a recession, we need, first of all, high unemployment. Now, this is, of course, not materializing yet. And unless we start getting some signs of this, it's hard really to justify a recession and a kind of credit collapse, right? In 2007, 2008, the kind of stuff that brought about the collapse, and the stuff that makes people default on debts really is higher rates contribute, of course, but basically losing your job and having no income is, of course, a lot worse. Now, this isn't happening at the moment. We have, as we can see, jobless claims reaching another, I think it was another 9-month low in the last report. So very, very strong labor market. So, things are a little bit different, right? And, what's going on with the labor market now? As we can see in this report, a couple of interesting points. Of course, labor force participation has been climbing up, but, very far, still quite far from where we were, of course, back in the early 2000s. And, still significantly below, well, a little bit below those COVID levels, what some economists have called the Great Resignation. And for the time being, we can see here per this data that national job openings versus number of unemployed workers continue to be positive, right? So there's more job openings than unemployed workers. So job openings have been falling quite steadily, but unemployed workers have continued to fall. Now they're beginning to rise. Now, so we are seeing now perhaps a bit of a trend reversal. Again, I think we need a little bit more confirmation, and to that extent, I do think this time could be a little bit different, just based on those labor dynamics. So if we don't get that increase in unemployment, it's hard to see that recession really take hold, right? We can also see here, for example, in any case, there is a labor shortage, which again could be a lot more systemic, right, rather than something short-lived. Now, however, the other reason I think that we could quote unquote avoid, or at the very least delay the recession, right, is that fiscal spending is basically gone through the roof, right, and that this is kind of to be expected given that we are entering an election year, right, and we can see here, for example, the fiscal deficit over the last few years. Of course, we had that big jump during COVID, and a little bit of reduction in 2022. Now we have another huge jump back to 2 trillion in 2023. So we have that fiscal deficit reaching 2 trillion. Now again, this isn't a guarantee that we're not going to have a recession, right? But it's definitely very interesting. This situation is kind of unique, especially if we look at the deficit as a percentage of GDP versus the unemployment rate, right? So we can see that never before have we essentially had such a high deficit with such a low unemployment rate. So again, it's hard to see signs of recession. And again, this kind of favors the idea of much higher nominal GDP and perhaps to that extent, much more resilient inflation, at least, in the perhaps in the longer term, right? And this kind of ties in a little bit with the idea of fiscal dominance that I discussed in my last newsletter, right? And we have this chart that I actually took from a report by Lynn Alden. She's talked about this quite a bit, right? And we can see here that we are basically kind of re-entering that period of fiscal dominance, have been since around the Great Recession, right? A couple of interesting things to note, right? First of all, the money multiplier, which measures kind of the effect that base money has on the broader economy, right? So the idea that when you add a dollar of reserves, right, moves to the economy, it, quote unquote multiplies. As we can see, the money multiplier has basically fallen substantially, right? This kind of reduces the effects that monetary policy can have, and then we've seen a big jump in fiscal policy. So obviously, as a response to 2008, we saw a big fiscal stimulus. Now again, because of COVID, we've seen a big jump in fiscal stimulus. And what's interesting now is that even without COVID and with low unemployment, we potentially have, of course, Ukraine war. We have the Palestine and Israel conflict going on right now. Of course, I believe Biden last week went out to ask for more money to fund these, right? So asked for 100 billion in funding to Congress. And basically, the question I posed in my last weekly report was, is this the 40s or the 70s, right? And, there's a lot of similarities with the period in the 40s, right? Of course, war is one of them, and the other one is big fiscal spending. Now, if we are entering this period of big fiscal spending, we can expect a couple of things, right? We can expect inflation to be persistent. We could expect bonds not to perform very well, right? This is 10-year treasury rate versus inflation, right? In that period of the 1940s, 1950s. But to that extent, stocks did reasonably well, right? They acted as a reasonable hedge against inflation, especially as we started, the 40s, right? We reached that low. And, even though the war was still ongoing here, we saw a big rise in equities. And again, ultimately, if you enter a period of high inflation, of course, commodities can help. But, basically productive assets are also a good hedge against inflation, right? I mean, if you look at the Argentinian stock market as defined in their own currency, it has done very well in recent years. Right now, again, we're not Argentina yet, but the point is that we're approaching that kind of level, right? What's interesting is, of course, that during this period of war, the Fed was basically had yield curve control in place, right? So they were keeping those rates lower. And while again, we're not there, it's kind of becoming inevitable that we are going to get there, right? I mean, the US is never going to default on its debt. And the way that the deficits are going, it's only a matter of time before the Federal Reserve has to step in. So to an extent, markets are getting ready to price this. At some point, you get to rates about 6, 7, 8%. It becomes inevitable that the Federal Reserve is going to become a net buyer yet again. So with that said, let's also talk a little bit about the Fed balance sheet and liquidity, right? So here we can see the S&P, kind of put up against the Fed balance sheet runoff and also Fed net liquidity. Now, Fed net liquidity also takes into account other measures of liquidity, right? Not just the balance sheet, but also the use of the reverse repo and perhaps also the TGA, right? So obviously a couple of interesting things to note here. While we have had QT, right, the Federal Reserve has been selling those bonds over the last few months and year. We can also see that, the Fed net liquidity has basically been picking up since around the middle of 2022. That's kind of when Fed net liquidity bottomed. And we've seen it continue up and basically hold a pretty steady correlation with the S&P 500. Now, of course, the liquidity and markets are often very strongly correlated, and that's something that we have to take into account, right? And the thing is that while you could say that the Fed has been tight in that it's been raising rates and reducing its balance sheet, well, again, the Fed turns on one tap and turns off another, right? We've had obviously the reverse repo facility getting used up, as we can see right here. So that obviously contributes towards liquidity, and it's basically helped fund the Treasury General account through those shorter term maturities, right? And we can see here, obviously, the TGA now pretty much almost refilled to the level it was back in May. So very interesting to note that. Now, the other thing, of course, is the bank term funding program, which also added significant liquidity. So again, even though you say rates are so high, with the Federal Reserve basically funding the banks and the reverse repo funding the government, the actual effect on quote unquote liquidity hasn't quite been so noticeable, right? And in fact, we could argue that we've had a favorable liquidity dynamics. Now, what happens next? So obviously, now looking here at the reverse repo, we are of course basically running out of it. So I mean, we can see that we're down to about $1 trillion here, and this could be running out sometime in 2024. So obviously, the federal government wants to have that TGA built up by then, and they are achieving this. Again, this is an election year, so they want to have those coffers nice and filled up, ahead of anything, ahead of the election, ahead of the possible escalation of geopolitical conflicts, or just ahead of a recession. Now, again, we're seeing that overnight reverse repo helping fund that TGA. So ultimately, in terms of liquidity dynamics, I think there's a lot of arguments to be made that we are nearing a turnaround. If you can, I mean, we already turned around in terms of liquidity further back, but even if the Fed continues with QT, we obviously probably reached a high in rates, right? So we're not going to see more rate hikes. We've got the TGA here, which is going to, probably some point in the next 6 months is going to start to be deployed again. So this will be liquidity re-entering the market, and of course, to that extent, that high degree of fiscal spending, which has been funded with reverse repo, again, it hasn't taken away from liquidity, and this is going to be re-added in the next few months. So again, the dynamics here are pretty good, right? Then we also have, if you look at overseas, right, obviously China will begin to stimulate. Japan might be a bit more hawkish. We'll see how inflation pans out there. Europe is getting really into the deflation territory, let's say. So obviously we expect them to start easing. So again, liquidity dynamics, over the next few months, I would say, are quite favorable. Now, moving on, I also want to talk about housing and real estate, because of course this is one of the big issues. Everyone is expecting houses to collapse. Now, we haven't quite had that yet. In fact, I'm going to propose that, this might be a good time to maybe dip your feet into some real estate if you haven't already, right? I have some charts here provided by Logan Matashami. So he's pretty big in the real estate sector. So definitely go check him out if you're interested. So first of all, we have here a number of consumers with new foreclosures and bankruptcies, obviously a lot lower than 2008. Again, here he's comparing to 2008, 2007. Yeah, everyone likes to talk about that comparison. Again, if you're trying to make that comparison, looking at some of this data, it's really not there, right? We look at foreclosures and bankruptcies a lot lower. We look, for example, at the HELOC balance and the credit limits, right? So we can see that basically the consumer isn't as stretched at all as they were back in 2007, 2008, right? On the other hand, we also have total balance by delinquency status. We can also see basically delinquencies a lot lower than 2008, 2009, right? I mean, nowhere near those levels, right? And just to wrap things up, you also have mortgage debt service payments as a percentage of disposable personal income, and of course, we are near basically all-time lows as a result of that very loose monetary policy we've had over the last 10, 20 years. Again, people think about the effects of interest rates. Obviously, it's going to take some time to play out, and it will play out. But to that extent, at the very least, in housing, if you talk about those effects of interest rates, right, we've had incredibly loose monetary policy for the last, at the very least, since 2008, with rates near zero. That's over 10 years. So, if you think about it that way, we've had over 10 years of really low interest rates. It might take 10 years to unwind that, right? I'm not saying it will, but obviously, this is something to take into account again. These high interest rates aren't affecting the consumer right now. That's something that's very that's already very evident. The only real threat, like I mentioned before, would be if, in fact, consumers lost their job. And at that point, it doesn't matter if you locked in at 3%, right? Because you just basically can't make the payments, and that's when the whole recession, let's say, kicks off. So again, that's why I think employment is a very important part of this equation. And again, we need to see that really be moved. Otherwise, I'm a bull, right? And for now, I'm a bull, given the last sell-off. And you look at real estate, right? We have here the XLRE. It has basically given up a lot of its gains in the recent months. Of course, people look at stuff like regular housing data, and maybe it hasn't come down as much, although it has been coming down. But you look here something like the XLRE, it's actually had a really poor couple of years, right? And from a technical perspective, we're at the 61.8% retracement of this rally. We're starting to see some divergence here in the RSI, right? So kind of here at the very least, not quite making lower lows while the RSI picks up. Also, we have rates which have probably topped out at this point. I don't think it's a bad time to potentially dip your feet into something like the XLRE or some of these rates, right? So again, unless we see something in employment shift a little bit, I think it's not a bad trade right now. And with that said, we can't end this report without talking about gold. Of course, gold has been on an absolute tear, in the last week. A lot of people are calling for a new bull market, myself included. But I show you this chart and I question the idea: has gold been in the bull market already for the last year? So what we have here is the gold price measured, of course, in euros, and as we can see, it's making new year-to-date highs. And basically, we can see, looking at this chart, gold has been in a bull market for quite some time. So of course, the US dollar, the DXY has been really strong. I do expect a reversal there. Of course, if you expect a breakout in gold, you probably also expect a breakout in silver. And, we have this interesting chart here by northstarbadcharts.com showing us the last 120 years of silver price history. Very interesting to see, of course. We got that breakout, kind of, filled out this wedge and got that breakout around 2010. And, arguably we are in a similar situation, right? Having completed this kind of a wedge structure, and basically if we can break out of this trend line here, getting ready for that next leg up. And gold, of course, in a similar position again, challenging this very kind of long-term uh, high that we set in 2020, and basically challenging those levels. And if we break above those, but then we really don't have any resistance above, right? So in terms of future projections for the gold chart using Elliott wave, we'd expect this to reach at least the 1.618 extension. That's about 250 in the GLD. So again, very interesting to see. And of course, the big test will be basically this area here, as we can see, this high we set here back in 2020, challenged it in 2022, failed, challenged it again this year, failed, and third time's a charm. So again, I do think that gold is very, very interesting here, and setting up for a potential multi-year rally, and again, kind of coinciding with a little bit of the idea that we could see, perhaps not over the next few months, since we're still kind of in that disinflationary trend, but definitely over the next few years, especially as fiscal stimulus probably just continues to grow, right? Because at this point, I don't see anyone trying to run back that budget deficit. And eventually, with the Fed stepping in, again, you need that something like a good hedge against inflation. Obviously, gold is and silver are great measures of that. And the other one is, of course, Bitcoin, which has really been breaking out in recent weeks. Now, from an Elliott wave perspective, it's a little bit messy. I don't love this structure. And, there's still a lot of leeway for a lower low in a wave two. But, with the kind of break above 30,000, well, we're kind of fighting that area right now. We could make an argument that, this could have bottomed already, and that we could be, on our way up for our wave three. So again, the big question here in Bitcoin will be that, the kind of the sell-off we see now, right? So if we see a corrected sell-off, then we could assume that this is the beginning of an impulse that will take us much, much higher, right? Looking just at the fib extensions, right? We'd expect something like a wave three taking us to about 78,000, and then a wave five to finish up along the 100,000 or even $160,000 range. Okay, and of course, we have that halving event coming in around April, so around here, we would expect to see a run up, based on previous cycles towards that, So we would expect the bull market to begin, as we approach that halving. So now the thing is, of course, in previous cycles, or at least in the previous couple, we have seen a much larger sell-off. So, for example, of course, we had this this big sell-off, for example, leading up to the previous cycle, right, to the previous halving. Of course, this also coincided with the COVID stuff. But anyway, this also happened in the previous cycle, right? We got that big kind of wave 1-2 set up, that big sell-off here where we reached about the 78.6% retracement. Now, that hasn't happened with Bitcoin yet. Again, so this is ultimately something that I was, kind of expecting. I think we had a good setup here, right? So we have, and we kind of still do, right? So we had the wave one here, and we have the potential for a retracement here in a wave two. 61.8% retracement takes us to around 20,000, and of course, there's a lot of volume coming in there. So it would be a natural place for Bitcoin to find support. But yeah, again, is that too easy? I mean, everyone would be buying Bitcoin right at 20,000 at this point, it seems like. So we might not get that retracement. Again, I'm still looking out for that possibility, and I think it would be great. But I'm starting to really favor the idea that this market could start running. Now, the other big reason for this, of course, is GBTC, and of course, this chart is a lot more bullish. This is already broken above. This is already broken above its previous highs, and already on the way to completing perhaps a whole impulse here in a wave three. So, very interesting to see that happening, of course, with the pending approval of the Bitcoin ETF, which everyone seems to be quite bullish on right now. And of course, if you haven't seen this chart already, basically the big reason why we have seen GBTC rally so much, and really outperformed Bitcoin actually is we've had this huge reduction in the discount rate, right? And sorry, in the discount to net asset value. So from about 40%, 40, almost 50% to right now, just above 10%. So huge reduction in that discount of GBTC, right? Now, it's important to note that, the bull case for Bitcoin and to an extent risk assets as well, but especially Bitcoin hinges on a reversal on the DXY. And again, not to pat myself in the back too much, but so far really playing out kind of as we expected, right? So we're basically looking at this larger ABC structure with that, wave B targeting around that 50% retracement. So I was talking about this level here, the 107 level on the DXY, and we turned just above that, right? Also, as the RSI got into the overbought territory, and now we're kind of forming a bit of a triangle here. Now, there's some room here to continue to make one more high, but overall, I think we're starting to see some signs of exhaustion. And again, this would be an ideal place to reverse here. Basically, that's what we need right now. I think, and I've been talking about this for the last week or so. Basically, what we have now is a setup for like higher. Of course, we've had that retracement, which we were expecting in equities. We have the 10-year yields reaching kind of our target level, and we have the DXY also looking like it wants to reverse at the moment. So, a lot of things coming into play now to really favor a run up in Bitcoin, a run up in assets, in risk assets as well, and and overall, I think just a continuation of this bull market. And just to go back to crypto for a second, worth mentioning that Solana has been a big winner in the last few weeks. Rallying over 20% in a few weeks. And a lot of this has to do with the FTX, right? So of course, FTX held a lot of Solana tokens. And, people were worried about FTX selling their tokens, but, basically that has happened now. Those tokens have been staked, and basically, the price kind of, with that kind of dark cloud above it has been able to rally, right? The Alameda FUD turned out to be less severe than anticipated. Last week, the FTX estate staked or locked up roughly 5.5 million SOL, worth 122 million at the time, easing investor sentiment. Okay, so we've seen a good, solid impulse in Solana, right? Now, again, Solana is one that, fundamentally I haven't really liked for a lot of reasons, but you can't really argue with the price chart. And, it's really been outperforming. It's been outperforming Ethereum. And, if people like it, you can't stop them from using it, I guess. From the chart perspective, we have a very solid 1-2 here, and another very solid 1-2 here. And now we've made a very clear impulse here. So again, if you're looking to get into Solana right now, this is a good point. I mean, if we can consider that we might get a bit more of a sell-off here, which is kind of what I'm looking at, right? I'm looking at maybe over the next week could be very, very key. I think the next week could be where we get that low in stocks. I think we could get a retracement in crypto, which would be a great buying opportunity. So definitely very important week coming up. And in terms of Solana, if we get that retracement now to about the 20 handle, right? So that's the 61.8% retracement at $21. Again, great buying opportunity if you ask me at around those levels. And that's pretty much it for today. I think we covered a lot of ground, fundamentally, technically. Of course, I do a lot more for my subscribers. Obviously, talk a lot about this stuff in the weekly reports that I do, and have a lot more technical analysis on various charts, as well as my portfolio there. And anyway, like I was saying, a huge week ahead of us. I believe this could be the week where the market finally bottoms, where hopefully we get a bit more of a retracement and a confirmation in crypto. And obviously, overall, big week ahead of us. I'll definitely be adding some positions, so stay tuned for that. As always, I hope you enjoyed this video, and catch up with you later.